Hello! Welcome to this week's Private Funds Update. I'm Sandra from SmartEsq, and today is Thursday, August 6th, 2026. Let's dive in. We begin with registered fund compliance. The SEC has settled its first ever enforcement action under Investment Company Act Rule 18F4, the Derivatives Risk Management Rule against ETF advisor Simplify Asset Management. According to the SEC's order, Simplify's ETFs repeatedly breached value at risk, or VAR, leverage limits peaking at 291% of the allowed ceiling, and failed to timely notify its board or the SEC after remaining out of compliance for over 5 business days. The order also cited failure to issue required return of capital distribution notices to shareholders across 7 ETFs. The takeaway for ETF and registered fund advisors is clear. VAR monitoring numbers and board escalation procedures are now a standard focus in SEC examinations. If your fund uses derivatives beyond a de minimis threshold, your risk management infrastructure and prompt notification protocols must be airtight. Sticking with ETFs, the SEC's Division of Investment Management has provided much-needed operational relief. SEC staff issued a no-action letter confirming that ETFs experiencing a passive exceedance of their 25% industry concentration policy can continue accepting creation orders without violating 1940 Act concentration rules. Previously, if market appreciation pushed an industry holding above 25%, sponsors faced long-standing ambiguity over whether accepting creation baskets containing those overweighted securities constituted an illegal, volitional increase in concentration. The staff's relief confirms ETFs can accept pro rata or custom creation baskets during a passive exceedance, provided the overweighting stems entirely from external market forces. Crucially, the SEC confirmed this relief applies to actively managed and index-based ETFs alike. Finally, across the Atlantic, Luxembourg is advancing one of its most significant private fund reforms in years. The Luxembourg government has introduced Bill of Law 8814, proposing to allow unregulated limited partnerships, specifically SCS and SCSP vehicles, to operate as multi-compartment umbrella structures. Historically, compartment segregation was restricted to special fund product regimes like RAIFs or SIFs. Under the proposed Article 28 bis of the AIFM law, an unregulated partnership managed by an authorized EU AIFM will be able to establish legally ring-fenced compartments, each with distinct assets, liabilities, and investment policies. For private equity, credit, real estate, and infrastructure sponsors, this allows parallel funds, co-investment vehicles, and multi-strategy pools to be consolidated under a single partnership, sharply lowering administrative overhead and launch timelines. That concludes this week's briefing. For a deeper analysis on how these changes affect your compliance programs and deal structuring, please review our newsletter and visit www.smartesq.ai.